Hey, it's Jim, and this is level 1 of the CFA program, the topic on quantitative methods and the learning module on time value of money. This is part 1. Very quickly, if we take a look at these 3 learning outcome statements, you might be tempted to think, oh, just 3 in this learning module. We'll be able to whiz through this pretty quickly. However, this is a relatively long learning module, and we've divided it into 2 parts, a total of about 70 or 75 slides. In this part 1, we're just going to address that first one. So notice it asks us to calculate and then interpret. So go ahead and get out your financial calculators. We'll do lots of these computations throughout the 40 or so slides in part 1. Let me just remind you what I warned you about in the previous learning module, that if you provide yourself with a solid foundation of understanding interest rates, which we just did, and now time value of money, which we're going to do in these 2 parts, you have a tremendous arsenal of tools so that you can build on those and price any kind of financial security that the CFA Institute throws at us in its program. So we're going to calculate and interpret present value. We'll do present value stuff initially, then we'll extend it. We'll apply it to fixed income securities and equity securities. And then even in this part 2, we're going to look at forward rates and option values. So this is pretty cool. This is a pretty cool learning module. I will say this on a personal level. Now, you guys that will be watching me throughout level 1 and, of course, levels 2 and 3, is that a lot of times I'll refer to when I went through the program 1,000 years ago, and these learning outcome statements were extended into multiple readings. So I think it's great that the Institute has condensed these topics and is introducing it here at the beginning of its program. All right, so let's go ahead and start with this concept of time value of money, which of course we talked about back in the previous learning module. It simply means that if I gave you a choice between $1,000 today and coming back tomorrow and getting that same $1,000, of course you'd pick the $1,000 today, even in the absence of inflation, because you could take that $1,000 and you could invest it. And so tomorrow, mathematically, it would be worth more than that $1,000. But there are a couple of extra things that we need to talk about here. This concept of opportunity cost, right? If you have this $1,000 today, you could invest it, or you could go buy something. Now, the question then becomes, you have lots and lots of consumption decisions, right? You could go to the food store, you could go to the electronics store, you could go to the car dealership, you could go anywhere for that consumption. So you have to look at that microeconomics cost, comparative cost of all of your consumption choices. So compare all those things to your investment choices. Now, what's the simplest of all investment choice? Just go down and deposit it into the bank. Or you could go out and buy a share of stock, or you could buy a bond, or you could buy some movie memorabilia. So whichever one of those things that you choose, whether it's the consumption today or the investment today, some economists call that savings, there's an opportunity cost, right? It's the return of the alternative investment, whatever that other investment might be. I use this concept of opportunity cost with my students all the time when they have their laptops out in class, and I say to them, all right, how many of you are paying attention and how many of you are playing Fortnite? And so, students, they never admit to playing Fortnite in class, but I'll say, look, if you're playing Fortnite, you are missing out on the tremendous value of my lecture. Then on the other hand, I said, if you listen to my lecture, you're missing out on the tremendous value of playing Fortnite. So you have to weigh those two alternatives. And then we always have to worry about inflation. We had a really good conversation back in the previous learning module about inflation. Simply means that if a loaf of bread costs $1 today and tomorrow it costs $1.10, well, it costs more, right? So inflation is, in general, a rise in the price levels and what that does. And this is super important for the CFA program. Look what we have there in that second bullet point. It's a loss or the threat to the purchasing power of money, right? It takes you only $1 to buy a loaf of bread today. Tomorrow it takes $1.10. So now that extra 10 cents you don't have to play Fortnite or to invest in a share of stock or to go buy a loaf of bread. Then the final concept is related to, all right, we make this investment today, what do we get in the future? Now, if it's a regular old bank deposit, we're pretty sure that that money and the interest that we earn on it will be around at some time in the future. Here, let me do a comma, unless, of course, you're a bank like SV Bank or any of those other banks that have failed. But still, there's uncertainty about those future cash flows. Maybe the bank will fail and you'll get nothing. Maybe the government will come in and say, you know what, we've been bailing everybody out for a long time, but we're not bailing you out. So there's uncertainty surrounding those cash flows, just like there is uncertainty surrounding the cash flows that you might receive if you buy a bond or a share of stock. So couple all of these elements and you are introduced to this concept of the time value of money. All right, here's a super simple equation there. We need to worry about present value, which of course is today's value. And we need to worry about future value, which of course is tomorrow's value. And what links future value and present value is the number of periods. Here we go. Look in the exponent. There's n, number of time periods, and it's linked by R. This is the interest rate per year. So let's do a quick, simple example. Suppose we start with $100 today. There's $100 of present value. Interest rate is 10%. And the time period is 1 year. So how do we get the future value? Well, you know, if you have $100 today, interest rate is 10% over 1 year, you know the future value is going to be $110. Well, how do we get that mathematically? Well, all we do is take 1 plus the decimal form of the interest rate. That's super important to remember. 1.10 raised to the 1 power times $100, and that gives us our future value of $110. Now, a concept that is present throughout the entire CFA program is this idea of compounding periods. So in that example, we went from 100 to 110. We assumed that interest rate was compounded annually, but banks or securities could pay interest whenever they want. I mean, some common time periods, of course, are semiannually, twice a year, quarterly, monthly. Of course, monthly, what do we do? You and I'm guessing, we make our car payments monthly, we make our mortgage payments monthly, but you can have weekly compounding, daily compounding. So what happens then is that every time that you chop the year into multiple periods, in order to calculate future value, you need to make a slight adjustment. So before I get to this next slide, I want you to get out your calculator. I've got my 12C right here. So I'm going to turn it on. I have to take my glasses off so I can see. So let's use our 5 time value of money buttons that go across, the top of your calculator. So let's do our first example. You ready? So let's do 100. Let's make that present value. So you do the 100 and then hit PV. Let's do 1 for N. 1 time period. Let's do 10 for I. Now, when you use the equation there, you need the decimal form of the interest rate, but when you use the calculator, you need the percent form of the interest rate. So put in 10 and then hit I. Now, we don't know what payment is. So make 0 payment. And then just hit future value. And there you go. You get 110. Notice the calculator has a minus 110 there. The calculator doesn't care whether you are the borrower or the lender. So if we had put minus $100 in there, then the answer would have been a positive 110. Now let's get to this concept of semiannual compounding. Well, what you could do is you could change a button on your calculator, and I'll show you that here in just a second. But the easiest way to do this is to make a slight adjustment with our 5 buttons. All right, so let's do this again. You ready? Follow along with me. Do 100, make that present value. 0 is payment. And by the way, the order of your inputs doesn't matter. And with semiannual compounding, we're going to make 2N, and then we're going to make 5I. And then hit future value, and you get 110 and 25 cents. So compounding twice a year gets you an extra 25 cents of future value. And then when you do it quarterly and monthly and weekly and daily, you just make the slight adjustment with the N and with the R. Now, the question then becomes, what's the maximum number of compounding periods? So we're going to be faced with this throughout levels 1, 2, and 3, this idea of continuous compounding. Now, those of you who know something about math or calculus, you might remember about probability limits and the limits as n approaches infinity. That's what we have there in our green little diagonal arrow point. But we need that little e to the x button on our calculator. I showed you this back in that previous learning module. But let's go ahead and do this together. So let's do the exponent together. Ready? So let's do n, which is 1. So do 1, and then we're going to multiply it by r. Once again, you need the decimal form. So multiply it by 0.1. So right? That's 1 times 0.1. So you should have 0.1 in your register. So then hit your e to the x button. Mine is the blue e to the x. And you get 1.1052. Multiply that by 100. And so you get 110 and 52 cents. So I'm going to put my calculator down and I'm going to say, look, if you start with 100 and you assume annual compounding, you'll have 110 a year from now. If you assume continuous compounding, which is the maximum number of compounding periods that is possible, you're going to end up with 110 and 52 cents. So 110 all the way up to 110 and 52 cents, that's the maximum number with continuous compounding. And then every other future value with semi, quarterly, monthly, they're going to be somewhere in between. Now, it took a while for me to get through this slide, but I think it was worth it. Hopefully, you think it was worth it. This is what I want you to do. Give me a thumbs up, even though I can't see you guys. All right, so here are the equations. We're just going to say future value over 1 plus r. That's the purple formula that our calculator just used. So here's my advice. You will almost never on an exam use that purple formula. Sometimes you will. And during the course of levels 1 and 2 and 3, I'll go ahead and remind you of when it's best to use that equation. And then for continuous compounding, we just raise it to the minus sign, which shows that we're dividing. So let's do just a quick example. 10,000 in your savings account needed, excuse me, at the end of 3 years, 10%. How much would you need to invest today? So here's my advice. The Institute is not likely to ask you the question that sounds like, hey, calculate present value, because then that'll send out some signals. What it's likely to say, and this is the way I do it on my exams, I'll say, how much do you need today to satisfy that future $10,000 obligation? So remember that today is the key word in that question stem. Now, I always tell my students this, and maybe you guys should do this, at least in the beginning of your understanding of time value of money, is draw a timeline. So we start with time period 0, and then we go at the end of the first year, and then at the end of the second year, at the end of the third year. So that's 3 years from today. Notice that the $10,000 is all the way out at 3 years. So how much do we need to invest today? Well, we know that that amount today has to be less, assuming that interest rates are positive, it has to be less than that $10,000, because what we're doing, hey, let me give you a quick test. What was that word? What was that term that I gave you in the previous learning module? What are we doing? We're discounting, right? We're going to use a discount rate to make that future $10,000 less today. So we can go ahead and do the math. We can do it the long way here. We can take the 10,000 divided by 1.10 raised to the third power, and we get that 7513. Or we can use the financial calculator. Now, what I'm going to do is I'm going to show you how to use this with an online calculator. So let me bring up my financial calculator here. And so I'm going to go ahead and clear. And let me give you pieces of advice here. Notice that I have 4 decimal places. This is what I always tell my students. I'll help you set this down here. Now, this is the online version of the Texas Instruments calculator. I have no idea why Texas Instruments doesn't have an online calculator. So this is just one I got off the App Store. And you can too, but of course you need the physical calculator during the exam. So look down here, it says format. So hit the second and then format, and the decimals will pop up. So you could do 8 if you wanted to, but 8, that sounds like a lot. Or you could do 4. So just hit 4 and then enter up here and then go ahead and clear. I think 4 decimals is sufficient. Now, what I also want you to do is make sure that you are setting this properly. So I want you to go to second and then look at the second function on there, P/Y. This thing needs to be set to 1. We're going to make the slight adjustment that I showed you just previously. What you could do for semiannual compounding, you could change that to 2. For monthly compounding, you could change it to 12. But then you run the risk of, during the stress and the pressure of an exam, is that when you get to the next problem, you will have forgotten to switch it back to 1. And then you're out of luck for the rest of the exam. So leave it at 1. All right, so let's do our very first problem here. So what was it? We had a future value of 10,000. So we're going to say 10,000. Was that 10,000 or was that 100,000? I can't see. All right, so that was a good mistake. So I can show you the back button here. Use the back button. So what are we going to do? We're going to make that future value. And so notice it pops up future value. We'll make 0 as payment. What was N? N is 3, so we'll do 3 is N. Interest rate was 10%. We'll make that I. So we're going to solve for this present value here. Remember what I said just a moment ago? It doesn't matter which order you input those. Now, the Texas Instruments people, you have an extra step. You have to hit this compute button. So we're going to hit compute, present value, and there we go. 75.13. And we'll round that up to 15. Now, I'll quickly go ahead and show you guys this. I don't have this as the online calculator. So remember to make it negative. So you're going to do, here, let me take my glasses off. You're going to do 10,000. And then you have to hit the change sign button, CHS. So that makes that negative. So then just hit future value. 0 is payment. 10 is I. 3 is N. Solve for present value. And you should get the same number there. $75.13. Now here is a slide on what I just spent all that time just a few minutes ago. When compounding periods are different than annual compounding, you can use those formulas there. But what did I just say? I just said you're probably not going to use those formulas. Just make the slight adjustment in the changing of the N and changing of the I/Y on your calculator. Boy, you have the R's and the M's and the N's in there. Boy, that looks like it's way too complex to remember. Simply remember the slight adjustment on your 5-time value of money buttons. That makes perfect sense. Now, back in the old days, what the Institute did was go in the next part of the reading was go through lots and lots of time value of money problems. But I think this is awesome because what we're doing is we're going to solve for present value, and we're going to apply that to some very simple financial securities. So here is the great lesson that I'm going to tell you today, and I'm going to tell you in level 2, and I'm going to tell you in level 3, that the price of any financial security is the present value of the promised cash flows from that security. Oh boy, that was a mouthful right there. You know what? Do I need to repeat that, or do you need to rewind? How about if you guys rewind so I don't waste too much of everybody's time? Oh, this is super important. So what are we going to do here? The next LOS, this is the first LOS, the next part of the LOS, fixed income securities. So what do we know about fixed income securities? These are bonds. Fixed income securities, these are issued by businesses like corporations, and they're issued by governments. And so what do corporations do when they issue a bond? Corporations issue hundreds of millions, sometimes billions of dollars in a bond issue to raise capital to invest in wealth increasing product lines. I mean, just think about it. Just get your phone out, and when you watch some type of an advertisement, well, somebody had to pay for that advertisement. And so, I'm a big golf fan, so I watched golf over the weekend, and there are commercials that come on the television. What are those commercials for? Rolex. What are those commercials for? Ford. What are those commercials for? Procter & Gamble products, right? Soap and shampoo, and we brush our teeth. So what do these companies do? They issue let's say $10 billion of a bond issue, and they use that capital to invest in their product lines. What they do is they borrow it from people like you and me, right? We're bond holders. So what do? These corporations, they make an explicit promise to us. I promise to pay you interest, and I promise to pay you principal. It might be over 10 years, it might be over 30 years, it might be over 50 years. Governments do the same thing. Governments borrow money to finance their budget deficit. Oh, we'll talk about length about that at some other learning module. Now, in the first learning module here at level 1, we talked about interest rates. So we need to be certain that we have the terminology down. When we're referring to a fixed income security, when we're referring to a bond, we call that interest rate the market discount rate. We also call it the yield to maturity. I always call it the yield to maturity. The Institute a lot of times calls it market discount rate, but those two terms are interchangeable. That's going to be the interest rate that we use to discount those cash flows. So look at that third block point. Present value of the fixed income instrument is calculating by discounting each cash flow. And that present value is going to be the price of the bond. Now, a couple of ways that borrowers can do this. They can do this with level payments. They can do it with periodic interest. They can do it with no payments at all. So let's start with what's known as a zero coupon bond. So notice what happens here. Time period 0, start of the contract. There's the present value. And at the contract maturity, let's say it's 1 year, it could be 5 years, it could be 30 years. That's going to be the future value of the security. So I want you to think about this. When corporations and governments issue bonds, what they typically do is issue them in increments of $1,000. So what was that example I gave you earlier? Procter & Gamble issued $10 billion of a bond issue. Well, they don't borrow it from just one borrow. They chop it up into more palatable pieces, $1,000. So you and I can buy into that $10 billion bond. Now, a zero coupon bond pays absolutely no interest. This is known as a discount security. And so this is exactly like the formula that we have been using here for these first 15 minutes or so of this slide deck. So notice that arrow point, also called a zero coupon bond. And there it is. The present value, which is the price of the bond, is just the present value of that $1,000. Now, let me go ahead and have a caveat here that while it's true that all bonds, most bonds have a par value or a maturity value or a future value of $1,000, it's the convention just to assume $100 because back in the old days, the Wall Street Journal needed space. And so it just chopped off that last zero. So the convention still today is to report the price of a bond in terms of $100 par value or maybe 100%. Either way is okay. All right, so let's go ahead and say, let's suppose that we buy a security for $8,000 today, and it's compounded at 8%. What's the future value after 4 years? Well, this is just a simple problem that we've done before. There's the formula down at the bottom, 1.08 raised to the fourth power. There you have the $10,883. Here, you guys want to do this on your calculator? Let me go ahead and pull out my financial calculator here. You ready for this? So there's my 7513 from the previous problem. So let's go down here at the bottom. So let's clear this. All right, so what are we going to do now? We're going to do 8,000. That's our present value. 8% is I/Y. 4 years is N. We'll make zero payment. We'll do that here in just a minute. And then we got to do compute future value. And there's our 10,833. Now let's go ahead and price a zero coupon bond. We typically call zero coupon bonds discount securities because of exactly what I have said to you in that previous example, assuming that interest rates are positive. But we thought it would be kind of interesting to put together an example where interest rates are negative. And you might ask yourself the question, why on earth would someone buy a security that has a negative interest rate? And the answer is, boy, it would have to be an extreme scenario. First time this happened, at least the first time I'm aware of this happening, was back during the Depression, and the U.S. government was issuing bonds at a premium. They sold for more than the $1,000, and that's because there was a depression. Banks were failing. People knew that their money was at risk. So instead of putting it in a tin can and digging it, putting it under their front porch, like that great movie, what was that movie called? Stand By Me. Sorry, I drew a blank there. Stand By Me. The poor guy buried all his pennies and then couldn't find it. But so what individual investors would do and institutional investors would do is just send their money to the government, and the government would kind of charge them a fee. Anyway, here's a really good example. Suppose the Swiss government in January of 2018, oh my gosh, go back and do a little bit of research on Swiss government there, at a negative yield of 0.08%. Well, what is that present value? So you do the math here very quickly. Whoops, I didn't mean to go ahead. So there you get 101.21. You guys want to do that in your calculator very quickly. So let's do this. You ready? Now notice in this case, we're going to use 100 Swiss francs of principal. So let's go ahead and let's do 100 is future value, 0 is payment, 15 is N, and then let's do 0.08, make it negative, that's I, and hit present value, and you get 101. Now you guys that did the four decimals, you should get 2077. Now, there are some bonds that are zero coupon bonds, but the majority of bonds pay interest. So the future cash flows look like this. There's time period 0 at the start of the contract, and then there is a periodic interest payment, the PM. Now, this is what you need to know is that these are called coupon payments. Coupon payments are the interest payments on the bond. So you get a coupon payment, that's an interest payment. You get it every year. Sometimes you get it every 6 months. Sometimes you get it every 4 months. You should be saying, oh, Jim, that's why you taught us about other than annual compounding. This is going to be relevant for pricing a bond as we move forward. So what happens then is that the bondholder receives let's say $100 every year, and then at maturity, the bondholder will receive that $1,000 in a principal payment. This is the standard timeline for a bond. Now, that PM there, that's a series of consecutive equal payments. This is known as an ordinary annuity, and the ordinary annuity button is not the ANN button on your calculator, it's the PMT. So recall that every example that we've done here, we've hit 0 for PMT because, right, it was a zero coupon bond. But now when we have these coupon payments, we're going to enter a number in there for the payment. So this is what the present value of a coupon paying bond looks like. All we're going to do is take the payment in time period 1, the payment in time period 2, and if it's a 15-year bond, we do it out to 15 years. If it's a 50-year bond, we do it out to 50 years. And then that future value is either going to be the $1,000 or if we shorten it to the $100. So here we go. Suppose we have a 5-year bond, face value of $1,000, annual coupon rate of 5%. And by the way, I'm pretty sure that the Institute on the exam, in the question stem, we'll go ahead and say, hey, assume it's a face value or future value or par value or principal amount. Those all mean the same thing of 1,000 or 100. Now, if it doesn't, then you can assume one or the other, and then in your multiple choices, you'll know that if the price is $98, then the future value was 100. If the price is $980, you'll know the future value was 1,000. So don't be upset if the Institute doesn't give you that face value. It's either going to be 1,000 or $100. All right, so this is super important. Coupon rate is 5%, so the coupon rate is going to give us the dollar amount of the coupon payment, the dollar amount of the interest payment, and we're going to take 5% of that face value. And then notice the next sentence, the market discount rate, think of that as the yield to maturity on the bond, is 6%. So all we're going to do is say, skip down to the bottom, present value is $50 divided by 1.06. Where did we get those numbers? Well, 5% of 1,000 is $50. So there's the ordinary annuity series of consecutive equal payments. And then we're going to discount them at the yield to maturity on the bond. Don't forget to raise it to the 1, the 2, the 3, the 4, and the 5, all the way out to 5 years. But then look all the way out at that very final calculation. You have to add the $1,000 par value to that last $50 coupon payment. Now you could get your calculator out and you could chug away and do all of those intermediate calculations. And if you do, you get 957.88. However, we're going to go ahead and use our financial calculator. So let me bring up my financial calculator and make sure you guys know how to do this. There's my 10,883 from the previous one. So let's just do a clear all. All right, so you ready for this? Remember, the order doesn't matter. So we'll do $1,000. I always have my students put in $1,000 first, future value, and then take the 5% of that $1,000. So there's 50. So do 50 is our PMT. Remember, in the zero coupon bond, that number was going to be 0. And then what was this? A 5-year bond. So 5 is N, and 6 was our yield to maturity. And so we're going to do compute present value, and there's our 957.88. Now, of course, I went through that whole rigmarole. Is that a word? My grandmother used to use that word. Is that a word used these days? That whole production about semiannual and quarterly and monthly. So here's a good example. You ready? 2-year bonds, semiannual coupons of 6%. If the required rate of return is 5%. Oh my gosh, here's another definition that we need. The definition of a yield to maturity on the bond, the market discount rate, is the required return on that bond. Let me just go back to my Procter & Gamble example. Suppose that I'm Procter & Gamble and I want to borrow $10 billion. So I issue a bond to you guys and you guys say, okay, Jim, what are you going to do with all that money? And I say, well, I'm going to invest it in new shampoo, right? And you say, hey, great, we need new shampoos out there. What do I get out of it? What do you as the bondholder get out of it? And I say, hey, how about if I pay you over 2 years? I'm going to pay you 6% semi-annually. Now that's an annual coupon. So instead of $60 every year, you're going to chop that in half. You're going to get $30 every year. And you say to me, you know what? We require 5%. So that's the definition of the yield to maturity. Do you got that? Let me repeat it. The yield to maturity on a bond is the bondholder's required rate of return. So be prepared. The Institute could give you on the exam market discount rate, yield to maturity, or the required rate of return. Now in this example, par value is $100. So notice we have to make the slight adjustment in our bullet points there. So periodic payment, periodic coupon payment, that's now $3 out of every 100. It's 30 out of every 1,000. And then the required return is only 2.5% per period, right? So you could do the whole, what was that word I just used? The whole rigmarole there at the bottom, but you don't want to do that. So let's get out our financial calculators and let's go ahead and clear out from before. So what are we going to do? We're going to say 100 is future value. We're going to say 3 is payment. And we're going to say 4 semi-annual periods over 2 years. And we're going to say 2.5 is I. And we're going to hit compute present value. And what do we get? I can't see. I need to squint. Boy, I hope you guys, when you get to be my age, I hope there's some kind of surgery that you can fix your eyesight for. All right, so there we go. 101.88. Beautiful. Now notice the first word in underneath the definition at the top, rare types of bonds. Yeah, perpetual bonds. Do you remember when you were in fourth grade or when you were 10 or 12 years old or whatever science class you had, your science teacher said, oh, here, let's consider a perpetual motion machine. Let's put a machine and let's just go around and around. Why doesn't this machine not go on forever and ever? Perpetual, right? And the answer, of course, was friction. I don't really know what the answer is here for perpetual bonds. Some corporations will issue a perpetual bond, which means that the coupons go on forever and ever and ever and ever and ever and ever. And then that maturity payment is so far out in the future that we don't really need to worry about it. So look at the, what is that, a turquoise box? I don't know, blue, green. So notice that the payment plus the payment plus the payment. So we do that all the way out for a perpetual time period. And so what do you guys know about perpetuity? I guess the only thing you know, and I'm just making something up here, is Buzz Lightyear to infinity and beyond. That's what we're trying to do. Price this bond that's going to pay coupon to infinity and beyond, whatever that means. Boy, weren't those some great movies. I will go ahead and confess that I had tears in my eyes when Woody gave his toys to that little girl in the whatever Toy Story movie that was. All right, so pay interest indefinitely. Now, the cool thing for you guys is that this perpetual bond formula, it shrinks to really, really simple one. All you got to do is take the payment divided by the decimal form of the interest rate. You don't even need a calculator for that. So let's do a quick example here. So we have a company issues $500 million in perpetual bonds, 4% semi-annual coupon, calculate the bond's yield to maturity, or calculate the bond's required return, or calculate the bond's market discount rate. Now notice in parentheses, we're saying $100 of maturity value. The market price is $98.50. So we're given the present value in this equation. We're asked to solve for that yield to maturity, right? The bond's yield to maturity. So all we need to do is take the coupon payment divided by the $98.50. So there, skip down to the bottom. You got the semi-annual is 2 divided by the $98.50, so that's 0203. But that's the semi-annual interest rate, so you have to annualize it over there on the right-hand box. So just multiply that by 2, 4.06%. I'm going to go back here and say this. Rare types of coupon bonds. I can't imagine that the Institute would give you this question on the exam because it's super rare. However, there are other applications of this perpetual bond example that the Institute might ask you on the exam. So this might not show up in this form on the exam, but it's likely to show up on another form, and you'll see that as we go through the rest of these learning modules. So this is super simple, so don't forget it. All right, how about if we go back and revisit this concept of an annuity, right? Annuity, a series of consecutive equal payments or cash flows. We just did this with a fixed income security, right? A bond, a coupon paying bond, pays same coupon every year for 5 or 10 years. However, what the Institute does in this particular part of the learning module is it shows some examples about ordinary annuity, which we've done before, and annuity due, and it applies them to, look at that example there, fully amortizing loans such as mortgages. So there's a problem at the end of this learning module about calculating the mortgage payment. Now, mortgage payments are typically monthly, so all you have to do is divide by 12 for the interest rate and multiply by 12 for the number of periods. And so that's a really, really super simple question. Now, the annuity due is a scenario under which the payments, they don't begin at the end of the period like they do with an ordinary annuity. They begin at the beginning of a period. And let me go ahead and give you this quick example. You know, when you show up at the insurance agent's office and you say, hey, I would like to buy some car insurance. And they go ahead and put your car in, they look at your driving record, they look at a bunch of other stuff, and the agent will say, all right, that's $1,000 for the year. And you say, oh, I don't have $1,000. And the agent will say, well, that's convenient because we allow for quarterly payments. Well, the agent is not going to allow you to leave the office without making an immediate payment. So you might have to pay $250 today, then $250, then $250, then $250. Your payments will sum to $1,000, right? But you'll pay them at the beginning of the period. And this is very, very common with insurance contracts. And it's common with lots of other financial securities out there. But the obvious example is an insurance premium. So remember, when the payments start immediately, this is called an annuity due. So what the Institute is likely to do, I do this on my exams all the time. I'll just give the students a question stem and I'll say, here's a bunch of stuff. And by the way, it's an ordinary annuity. Or by the way, it's an annuity due. So that of course changes the calculations. Now here's the timeline for the ordinary annuity. These are the mortgage payments. These occur at the end of the period. Now, well, this is what I want you to do. I want you to take a look at these two equations. I want you to, do you remember in that great Seinfeld episode where George got mesmerized by some painting and his eyes went like this? Oh, that's a great Seinfeld episode. I want you to stare at these and I want you to, don't blink. I want you to stare at them and see what happens. And then I want you to wipe those things out. There's no way that you're going to memorize these. You're going to use your 5 time value of money buttons on your calculator. But it's important to know that when you hit PV or you hit FV to solve for the future or present value of an ordinary annuity, what you're going to do, your calculator is using that equation. Yeah, consider a fully amortizing loan. Yeah, the borrower receives the mortgage loan now and promises to make periodic payments. So a mortgage loan is an ordinary annuity. And here's just a simple example of what happens with a fully amortizing loan. You probably know this with your mortgage payments. What do? Yeah, let's suppose you borrowed $200,000. It's over 30 years, and your mortgage payments are, let's just say $1,000 a month. So part of that goes to interest, and part of that goes to principal. What happens early on in the mortgage repayment process is most of that goes to interest. There's the blue. So every time you make a payment, your interest is a little bit less, a little bit less, a little bit less. All the way to the end, you're paying just a little bit of interest because you don't owe nearly as much. And that should make perfect sense. Yeah, there's the equation for the periodic annuity of a fully amortizing mortgage. There you go. Don't do the whole George Costanza thing there. You don't really need to worry about that. So let's go ahead and do an example. Here we go. And by the way, there's an example just like this at the end of this learning module. So that signals to me that, boy, if the Institute thought it was important enough to put it as an example at the end, it's probably important enough for you to know for the exam. All right, 25-year mortgage. The interest rate is 4.5%. Let's see, we borrowed 75% of that. All right, so we can use the formula there at the bottom to calculate our mortgage payment. I'm not sure we want to do all that. Well, we could do this. You guys love math. If you love doing ratios and doing all sorts of crazy things, go ahead and get your calculator out and solve for that 3335. Or you can get out your financial calculator and let me go ahead and do that with you. All right, so let's clear it out. So what are we doing here? All right, so let's do this. Actually, let me go back. Let me go back to this one here so I can see all the terms. So for 25 years, let's just do this. Watch, we'll do 25 times 12 equals, there's the 300. So we're going to make that N. And what's the interest rate? We're going to do 4.5, and we're going to divide that by 12. So there's our 375. So we're going to make that the interest. And future value is going to be zero, right? When we repay the loan, we're not going to owe anybody anything. And so how much are we borrowing? So what's 0.75 times 800,000? Is that the right amount of zeros? We're borrowing 600,000. So we make that present value. Remember, the loan amount is always present value. So let's do compute payment. There we go. 33, 34, and 99. There we go. Now, hopefully you are following along with the calculator. You're getting all those correct answers. Should be perfectly fine. Those of you who have the 12C, which I do, you should be following along with this just as well. All right, so that concludes our discussion of the LOS, calculate and interpret present value of fixed income. Now we have to move over, calculate and interpret present value of equity instruments based on expected future cash flows. All right, so this is going to be super simple. You ready? So Procter & Gamble, what did we do? We issued $10 billion in a fixed income security to invest in soap or shampoo, whatever that was. But corporations, they also can issue shares of ownership. They can say, hey, we're going to issue equity. We're going to issue shares of our stock. So Procter & Gamble, they could issue 5 billion or 20 billion or 50 billion. And so now instead of Procter & Gamble borrowing money from the bondholders, Procter & Gamble is now borrowing money from the shareholders. Bondholders get interest and principal payments. Shareholders get dividend payments. So just like the price of a bond is the present value of the coupon payment and the principal payment, the price of a share of stock is going to be the present value of the dividends. So as a shareholder, when you become an owner, a shareholder in a publicly held company, you have the right to receive a dividend payment. So we're going to apply our time value of money principles to the price of a share of stock. It's going to be the exact same general thought process that we had here to price a bond, but we're going to have to make a slight adjustment. And that slight adjustment is the simple fact that if you buy a bond, most bonds, there's going to be a maturity date. So if it's a 10-year bond, you're going to be a bondholder for just 10 years. But if you buy a share of stock, you could be a shareholder for the rest of your life. And then when you die, you could leave that share of stock to your son or daughter or nephew or niece, and they could be a shareholder for the rest of their lives. So we value equity securities as if the company were a going concern, meaning that it never is going to die. You should have learned that back in your management class. Of course, if you ever take one of my finance classes, you would have learned that at the very beginning. All right, so what we need to do, look at the very bottom teardrop points. We need to worry about dividends. We need to worry about growth rates, and we need to worry about changing dividends. So we're going to look at 3 models here to conclude this first part of Module 1. Now, remember I said to you back in that perpetual bond model, I said, hey, you're probably not going to get that in a perpetual bond model question on the exam, but you might get it somewhere else. Well, here's the first case of where we might get it somewhere else. So let's suppose that Procter & Gamble decides to pay a constant dividend. So it makes sense that we're going to use a constant dividend model. So if I'm Procter & Gamble and I borrow $20 billion from you guys, right? You'll say, what do we get out of it? And I'll say, hey, how about if I pay you a $5 dividend? Well, there's the $5 dividend. And I'll have to say something like, hey, that dividend is fixed. This is a preferred stock issue, by the way. So if that dividend is fixed, then you know that I'm going to pay you, or I'm promising to pay you $5 every year, forever and ever, and ever and ever, and ever and ever. I always say this to my students to bring some levity into this conversation, until the earth collapses into the black hole from the sun, and the earth gets sucked into whatever a black hole means. I love science. I don't know anything about science. I love watching those documentaries on TV. I don't even know if our sun could collapse into a black hole, or the earth could collapse into a black hole, but sooner or later, something like that's probably going to happen, but we're not going to be around to witness that, right? No matter how many of those Independence Day movies or Event Horizon movies that we watch, it's probably not going to happen during our lifetime. All right, so this is super simple, right? That dividend, that fixed dividend goes in the numerator, and then the denominator is going to be, well, let's call it something, right? We don't want to call it yield to maturity because that term applies only to bonds. We could call it a required rate of return. Oh my gosh, that's absolutely appropriate. We could also call it the discount rate. And that's what the Institute calls it, at least in this part of the learning module. So let's do this simple example. You don't even need my calculator, right? So $5 dividend per year, the required rate of return, 8%. So all we're going to do is take $5, divide by 0.08. Remember, decimal form of the interest rate. So this is super important. Make sure that you know when to use the percent form, when to use the decimal form. So there we go. Price of that constant dividend paying share of stock, $62.50. Now this is what we know. We know that most corporations, when they pay dividends to their common shareholders, we know that those dividends change over time. So how do we deal with this if the dividend changes over time? Well, we're going to get to that later in level 1 and level 2 and level 3. We're going to talk about some intricacies of this model. But for now, let's just simplify stuff and say, let's suppose the dividend grows at a constant rate. So look down almost at the very bottom of the green box. There's the lowercase g. That's the constant growth rate. So let's go back to this. You ready? I'm Procter & Gamble, and I borrow a bunch of money from you guys as my shareholders. And I say, hey, how about if I pay you $1 dividend next year? And you say, hey, you know what, Jim? That sounds like a great idea, but that's a good starting point. We know that you're super smart. And we know that you're going to take all of our money, what did I say, $20 billion, and you're going to invest it in a great shampoo product line, and that product line is going to be profitable in the future. So we want to share in that future profitability. So you say to me, you say, hey, Jim, that $1 is a good starting point, but we want more going forward. And I'll say something like, well, how about if I pay you 5% on top of that $1 every year forever and ever? And then you say, hey, now we're getting somewhere. We're going to get an extra 5%, right? That 5% is going to grow every year. We're going to share in the profitability of the company. So this is called the constant dividend growth model. It was developed back in 1956 by a dude named Myron Gordon. And I always call it the Myron Gordon growth model. And that's probably what I will call it throughout levels 1 and level 2 and level 3, because what Myron Gordon did for us is he took essentially an insurmountable mathematical problem and he condensed it into that thing right there above the green box. So all we need to do is take the present value of the dividends. Boy, look at that arrow point. What did I say to you at the very beginning of this slide deck? The price of any financial security is the present value. So look, the present value of the stock is equal to the sum of its future dividends discounted by the required rate of return. So notice on the far right side over there, we've got the dividend in time period t plus 1. So the t is 0, so time period 1 divided by r, which is the required rate of return, minus that growth rate. Oh man, this is so cool. You guys should be high-fiving each other saying, you know what, this is why I got into the CFA program, to learn stuff like this. All right, you ready? Stock pays, currently, that's an important word there, annual dividend of $2, required rate of return on the stock 10%, dividends are expected to grow 5%. What is the present value of this share of stock? Now remember, the Institute could also say to you, what is the price of this share of stock? This is super easy. Now this is super important here. You ready? The Institute could either give you D1, let me go back here, could either give you D1 or it could give you D0. In this case, it gives you D0, right? So we need to figure out what D1 is. So look down at the bottom. So D0 is $2 multiplied by 1 plus the decimal form of the growth rate. So the dividend today is 2. The dividend a year from now, that's the numerator, that's the input. $2.10, and all we're going to do is divide that by the decimal form of 10% minus 5%. So there we got a price of a share of stock of $42. Now, let me go ahead and just editorialize here for just a second. You might be saying to yourself, wait a minute, Jim, this is very beginning of the CFA program. This might be a super simple model. Does it have any application? And the answer is, well, no. There's no way that you can use this $42 to go buy low and sell high on the floor of the New York Stock Exchange today. However, I will say this, and this is very important. If you look at the annual report for corporations, now in the old days they used to give you physical copies, but now you can just go online and get an annual report. The very end of the annual report, the corporation always reports what its average quarterly price was for the previous year. So you look at, might say, quarterly stock price during January, February, March was $38. April, May, June, $31, and so on. Well, this does a great job of giving you a base value for the company. There's lots and lots of other variables that we'll talk about throughout the program, but this gives you a good starting point. Oh my gosh, and that's what the Institute wants us to learn. Starting points, and then build on that starting point so that we can refine our analysis. So please don't discount this as a simple model. Myron Gordon did us a great favor, so we want to honor his memory by attaching the level of importance to this that it deserves. Now, granted, it's not going to make you a millionaire overnight. Now, what happens if a company does not have a constant growth rate? Let's go back here real quick. What if G changes? In this case, G is 5% forever and ever and ever and ever. That is what we call in the academics a super limiting or a super restrictive assumption. So let me give you an example here. Let's suppose that I'm Jim's concrete firm, and I come to you and I say, hey, I want to issue a bunch of shares of stock. I need your money, $100 million, because I have an idea for new concrete. It'll never crack. It'll never fade. You won't have to go out like I do, and my wife loves doing this, pressure washing the sidewalk when the mold and all the dirt and all the bird droppings come on top of, so you don't have to, it doesn't crack. It's resistant to bird droppings, et cetera, et cetera. Revolutionize the industry. So what's going to happen? I'm going to have lots and lots of profitability early on, right? I'm going to dominate the market. Maybe my growth rate is 100%. Maybe it's 50%, maybe it's 30%, but it's some big rate that is not sustainable. You get that? It's not sustainable because sooner or later my competition is going to come in and they're going to say, oh, you see Jim over there? He's charging you $500 to do your sidewalk. However, we're going to do it for $480 or $420, right? All right, so that competition. So how do we do this? Well, as you can imagine, we're going to use a multi-stage dividend discount model. Now, I give you that example because it's really a good visualization to say, okay, we can start out with high, super high growth rates, and then they're going to revert to a more normal growth. But it doesn't have to be. You could have a growth rate of 8% for 5 years and then 2% for the rest of that time period. Notice that third block point, multi-stage dividend discount models are just extensions of what we've done before. So there is the case that I was describing at the bottom. Consider a company with a higher short-term growth rate. Notice that's noted as G sub S for short-term, followed by an indefinite lower and stable growth rate. So what was that word I just used a few minutes ago? That super high growth rate is not sustainable. And so the Institute then is going to use the word stable once that unsustainable growth rate then falls to a more stable rate. And so the present value, all we're going to do is chop the timeline into two parts, the high growth part or the short-term growth part, and then the long-term growth part. Now we're going to have to get used to using a formula, and I'll show you that here in just a few seconds here. So what we need to do is we need to calculate the present value of the dividends during the initial period of higher growth. So all we're going to do is we're just going to sum the dividends over that period. So let me just give you a quick example. Let's suppose that, what was I? Jim's Concrete Company, right? And so I offered to pay you $1 dividend at the end of year one. And then I'm going to say, you know what? I'm going to double that at the end of year 2. So I'll pay you $2 at the end of year 2. And then I'll double it. I'll pay you $4 at the end of year 3. And then how about we do one more period? And then I'll double it to $8 at the end of year 4. So this stage 1 is we need to compute the present value of the $1, present value of the $2, present value of the $4, and present value of the $8. That's what we're doing here. That's the summation over that 4-year high growth period. In fact, lots of textbooks call that the supernormal growth period. Those of you who ever watched Barney during your life, and I know some of you did, my daughter is about your age, and I watched Barney. Sometimes I call this the super duper growth rate. Boy, how silly is that? Where else can you go to combine Barney the dinosaur and level 1 CFA stuff? Now, before I get to the next slide, let me just say to you, look, how long is it possible for me to continue to double my dividend? Well, as talented as I am and as great as my cement product line is, sooner or later competition is going to come in so that that's sustainable for, in my example, just 4 years. So my advice for you is to be prepared for the exam for maybe 3 years. That sounds like a reasonable time period. Maybe 4, but not 5 or 6 or 10. I mean, the mathematics of it just gets too cumbersome. And remember, the Institute is hoping that you get through each one of these multiple choice questions in around, 2 or 3 minutes. So if you have a 10 or 12 year high growth period, boy, that just that throws that time period just way off. Now, what the second part of this second stage is exactly what we did with the Myron-Gordon growth model. Notice that the present value there at time period T, so that's a future value. So notice we have an E and then parentheses ST. That ST is a future stock price. Ooh. This is called terminal value. We're going to put that in the numerator. And this is going to be the present value of that long-term, infinite, stable growth period. So really the price of a share of stock is going to be the present value, in my case, of those 4 dividends, right? Present value of the 1, the 2, the 4, and the 8. And then we're going to make the assumption that we're going to sell that share of stock at the end of year 4 for some future value. That's called the terminal value of that share of stock. Terminal meaning at the end of that unsustainable high growth period. All right, so we're going to have to go through and work through this the long way. So here we go. $2 dividend in one period, high dividend growth rate of 20% for 3 years. Okay. Followed by a slower growth rate of 5%. So that should make sense given my previous 5 minutes of discussion. There we have a required return. Notice we just call it a discount rate of 10% in this example. Calculate the present value of the share of stock. So let's do this the long way. Let's take the present value of the $2. Let's take the present value of the $2 as it grows by 20% for 1 year and then by 20% for 2 years. So that's the numerator in period 1, 2, and 3. If you take the present value of that, you get 5.965. Now, at a future date, relatively soon, I'm going to show you how to use your cash flow button on your calculator. I don't want to take the time to do it now, but this will be a shortcut. So those of you who know how to use your cash flow button on your calculator, you could do that right now. So there you got, what's that, about $6. So let's do the lower growth period, and let's do the 3 in the numerator. That's what I call my students the very first stable dividend, or the first normal dividend, and then we're going to divide by 0.1 minus 0.05. So that's our expected selling price of the share of stock. That's the terminal value. Take the present value of that over 3 periods. So we just sum those two together. Now, what you could do is you could use your cash flow button. So those of you who don't know how to do that, just pause and say, trust me, Jim is going to show this at some time in the future. But what's the point here of our part 1? Our part 1, boy, we did a lot of good stuff. We started with present value, then we applied that to the price of a fixed income security and the price of an equity security. This was really, really cool stuff. Now, what I regularly do is I regularly send candidates to this learning module, and I'm going to do that for you right now. I want you to take 10 minutes. I want you to take a look at the there's only a handful of problems here. Some of them you might be able to do. There's about 4 or 5 of them. Some of them you won't be able to do. I'll send you to the end of the learning module after we do part 2. So I want you to go through, look at those questions. If you can do them, fine. If you can't, at least you get a sense of what the Institute is thinking and what is important. Hey, thanks for watching. Have a great day. Good luck studying, and I'll see you in part 2 shortly.